Kenya's Monetary Policy Committee today retained the benchmark central bank rate at 10% to anchor inflation expectations. Now, the committee noted that month-on-month overall inflation had declined to 6.4% in December from 6.7% the month before, but food inflation remained elevated in December due to unusually dry weather conditions. Food and electricity prices are expected to remain high in the near term. The foreign exchange market, in the MPC's view, remains relatively stable. Uncertainties, however, have increased related to global growth, future policies under the new US administration, and of course the outcome of the Brexit negotiations. International oil prices have also risen moderately, largely due to an agreement by major oil producers to cut supply. Now, earlier on, I spoke to Gibran Qureshi, Standard Bank's regional economist in charge of East Africa. We focused on how Kenya's drought may affect Kenya's monetary policy this year. As he pointed out, just because rates went up during the 2011 dry spell and combined with a weakening currency doesn't mean you should expect the exact same thing this year.
I mean, that's an interesting one. So we saw that in 2011, but the difference back then was
we also had a weakening currency at the time.
Exactly. Yeah. Rising oil prices, weak currency, and I think the economy was generally overheating back then. This time around, we have no real domestic demand-driven inflationary pressures. But as you correctly mentioned, it's mainly supply side. But what that does is, if you do have headline inflation rising because of food, and obviously it looks like we are in a period of a drought within the region, then you need to ensure that real rates are attractive. So you can't sit back and remain oblivious that the yield curve shouldn't react to that. So we need to see an adjustment in the shorter end of the curve, or if the real rate is compressed, that could eventually keep the carry trade in a very ominous situation.
Right. Moving forward, though, there's this interesting little chart, reserves falling by better part of $700 million between the week in which Donald Trump was elected, so that's the week ending November 10th, and the 19th of January this year. $683 million was a precise number. Do we know exactly where that money went? What were we spending it on? Hopefully not currency support.
It's difficult to tell, but when we look at the numbers, broadly speaking, between October and December, we lost about $782 million in FX reserves. And of course, we need to acknowledge the fact that in December, we had about a $90 million Eurobond coupon payment. But that said, there's a lot more in reserves that went. But a big part of that was definitely, went towards sell-side intervention from the regulator to actually smoothen out the weakness of the shilling. And of course, looking ahead, a lot of people are getting concerned by the dwindling FX reserve position. But, I'd actually say, look back at the last 2 years, 2014, a better part of the end of 2015, and of course, mid-2016, every time reserves dwindled, we actually saw the government issue an external loan and, reserves would be back up. So I'm not saying that's the best way to actually support your external account position as an economy, but I think it buys you time and gives you more ammunition and buffer as a central bank to ensure that any potential weakness going forward in the local unit is measured.
Right, but isn't this time perhaps slightly different because we have that standby credit facility with the IMF as well? So perhaps the central bank might be looking at the reserve position and saying, guys, why are you panicking? We've got an insurance policy from the fund.
The thing about the IMF facilities, obviously the board did meet a couple of days ago on the 26th of Jan, and it is clear that it's now looking like a formality that if the Kenyan government wants to draw upon that facility, they will be able to. And that's because the drought condition can be classified as a balance of payment shock. But I think, they'll probably use that as a last resort. If they do get this potential external loan that's budgeted, in the FY 2016-2017 fiscal year, then, if reserves fall on the back of that, then they may opt to go to the IMF facility. Remember, we need 4 months import cover or less, and of course that means reserves potentially have to fall to $6 billion. So if you think about this, if we're getting roughly $1 billion in an external loan, and our current FX reserves position is $6.9 billion.
Yeah, 6.8.
Yeah, 6.8. We're going to be back closer to the $7.8 billion level. So reserves have to drop like a stone for them to actually be convinced that we're heading towards the 4-month import cover, regulatory minimum, and that could perhaps prompt them to go to the IMF and say, we now need that facility, because as you know, it looks quite inevitable that we are going to be importing a lot of food